Welcome to the Deep Dive. We're here to cut through the noise on complex financial stories. And today, we're really unearthing something big. It's been bubbling under the surface of the U.S. housing market for years now. We're talking about the future of Fannie Mae and Freddie Mac F2, as you often hear them called. You've brought in some really compelling sources. There's a detailed investment thesis from Bill Ackman, plus some very fresh updates hinting things might be moving faster. So our mission today: distill the key insights, unpack the arguments, and help you understand not just what's going on, but why it matters, why it could really reshape a cornerstone of the U.S. economy and, what it might mean for you.
It really is a fascinating landscape. You've got government policy, market dynamics, and a very specific investment strategy all colliding. We're going to break down the case for privatizing these GSEs, the huge financial implications, and why some folks like Ackman believe there's a unique, maybe even asymmetric opportunity opening up right now.
Okay, let's jump right in then. The central figure here, the one really driving this recent buzz, is Bill Ackman, CEO of Pershing Square. His Art of the Deal presentation from January 2025,
Right.
it lays out this really powerful case for investing in the common shares of F2. And it's specifically banking on them getting out of government conservatorship, especially perhaps under a potential Trump administration. So the first question, I think, for a lot of people is, why common shares? Aren't preferred shares usually, safer, a clearer path to getting your money back?
That's exactly the crux of it. And Ackman argues pretty forcefully that common shares are actually the much better bet right now. He's got several key reasons that, they really challenge that conventional wisdom. First off, and this might surprise some listeners, the argument is the government has already been more than paid back for the bailout.
More than paid back.
Yeah. Think about this. Treasury got $301 billion in payments from Fannie and Freddie. That's $25 billion more than what was contractually required for the senior preferred stock, the SPS, that it holds.
$25 billion extra.
Exactly. And according to Ackman's analysis, this overpayment happened, over 5 years ago.
Mhm.
So effectively, the government's initial investment plus interest has been covered, and then some.
Okay, so the government's investment is paid back, right, with a hefty profit. That definitely seems to weaken the case for keeping them under wraps, doesn't it? But what's the counter-argument you usually hear? Why might some still say, no, keep them in conservatorship, even with that overpayment?
That's a fair question. I mean, the main argument is usually systemic risk, right? That F2 are just too big, too important to the housing market to be fully private without strong government oversight. But Ackman counters that with a second really powerful point. The government's own economic interests are, maybe surprisingly, pretty well aligned with the common shareholders.
So?
Because Treasury holds these things called penny warrants. They give the government the right to buy almost 79.9% of the common stock in both companies for next to nothing. So think about it. If the government were to just forgive that big SPS liability, the value of the common stock goes way up. And since Treasury owns warrants on 80% of that stock,
They capture most of that value increase anyway.
exactly, they immediately recover nearly 80 cents of every dollar forgiven just through the increased value of those warrants they already hold. Plus, that $25 billion overpayment acts as a cushion against any, leakage to the public shareholders. From that viewpoint, it's almost a win-win for the government.
This is compelling stuff. So, okay, what does Ackman actually project? For investors looking at these common shares, what's the potential upside, according to his thesis?
Right. This is where the numbers get really eye-popping. Ackman sees significantly higher potential for the common. He's projecting Fannie Mae's price could hit around $35 by 2026, and Freddie Mac maybe $39 by 2027.
Okay, put that in perspective for us from where they are now.
From recent trading prices, yeah, we're talking potential returns of roughly 650% for Fannie Mae and 780% for Freddie Mac. And these aren't just numbers plucked out of thin air. They're based on mid-teens price-to-earnings multiples. He benchmarks them against stable businesses like, say, property and casualty insurers or utility.
Okay, makes sense. Stable, cash flow generating businesses. And beyond the pure financials, Ackman also points to, the political angle, right? Strategic value for an incoming administration.
Definitely. President Trump, for instance, he actually committed publicly back in 2021 to getting F2 out of conservatorship. And Ackman adds this interesting detail. A lot of the F2 common stock is held by, and I'm quoting here, many millions of retail and institutional investors who are Donald Trump supporters. So unlocking value for them, that could be seen as a political win.
Interesting. And what about the broader economy? You mentioned Secretary Besson's idea.
Right, Scott Besson. He floated this idea of making Fannie and Freddie core assets in a potential U.S. sovereign wealth fund. What's really fascinating there is thinking of F2 almost like a perpetual royalty on first mortgages secured by the U.S. housing market.
A royalty stream for the country.
Exactly. It provides this low-risk, high-risk adjusted return, generates big, growing dividends over time, and those dividends, they could then be reinvested into other assets within that sovereign fund, maybe generating returns much higher than the cost of U.S. debt. It could actually help the country deleverage without raising taxes. It sort of reframes F2 from a past problem into a future national asset.
So if this privatization path is the goal, what's the actual blueprint? Ackman lays out a framework, right? How does it work?
Yeah, he outlines four pretty clear steps. First, he proposes cutting the equity capital requirement.
Lowering the bar.
Well, lowering it from 4% down to 2.5%. The argument is that F2's business guaranteeing mortgages is inherently lower risk than, say, a traditional bank holding lots of complex assets, so 2.5% aligns better with that risk profile. Second, and this is critical, you need to restructure the capital stack. That means treating Treasury's senior preferred stock, the SPS, as already repaid, like we discussed.
Yeah.
Clean up the balance sheet.
Got it. Clear the decks.
Exactly. That clears the path for step 3. New private capital raises.
The re-IPOs.
Right. He envisions Fannie raising maybe $5 billion by late 2026, Freddie perhaps $15 billion by late 2027. This brings fresh private money in, sets them up to operate independently again.
And the final step. What happens with the government's stake?
That's the monetization piece. Treasury would then gradually sell off its 79.9% warrants over, say, 5 years after the IPOs, the potential there. Ackman estimates it could generate over $300 billion for the government over time. So even without holding onto the SPS, the government still benefits hugely from the company's future success.
Okay, let's pivot to what the market's been doing lately, because the price action really tells a story here, doesn't it? Over the past 6 months, we've seen this big divergence. Fannie Mae's common shares, up something like 400%. But its preferred shares are up maybe 175%. Yeah, that disparity is pretty stark. It's a strong signal of, well, heightened investor optimism about the common shares. The market seems to be betting heavily on Fannie Mae actually exiting conservatorship, probably influenced by proposals like Ackman's.
And the preferreds. The preferreds, well, they're tied to a more capped payout structure, right? Their potential is more limited. So they've seen solid gains, but nothing like the explosive growth in the common. Investors are clearly looking to the common equity for that bigger upside potential.
Now, drilling down a bit further, something specific in your sources caught my eye. The price difference between Fannie Mae, FNMA, and Freddie Mac, FMCC, common shares. As of, say, late March 2025, Freddie Mac was trading at about 80% of Fannie Mae's price. So if Fannie was $6.21, Freddie might be around $5.16. Why that discount on Freddie?
Yeah, that's interesting. It seems to stem largely from perceptions shaped by Ackman's own presentation back in January. Remember, he laid out a staggered ITO timeline. Fannie first by the end of 2026, then Freddie Mac a whole year later in 2027.
Ah, so the market's pricing in that delay for Freddie.
Seems like it. That earlier potential exit for Fannie leads investors to give it a higher near-term value. They anticipate quicker clarity, maybe quicker gains. Freddie's later timeline just introduces more uncertainty, so it gets discounted.
But, as your sources suggest, this discount might actually be an opportunity. Freddie Mac is a potential sleeper hit.
Could be. Fundamentally, their businesses are very similar. Both guarantee mortgages, both earn similar guarantee fees, usually around, 60, 61 basis points. If Freddie does achieve that proposed 2.5% capital ratio, its earnings power is projected to be quite strong, maybe $10.3 billion a year by 2027. That could easily support a valuation similar to Fannie's or maybe even higher over time.
So the market might be overreacting to that one-year lag.
It's possible that 80% price level might not fully reflect Freddie's underlying profitability. So for investors willing to tolerate a bit more risk, or maybe with a slightly longer time frame,
The potential percentage gain is higher with Freddie.
exactly. If Freddie hits Ackman's target of around $33.77 from, say, $5, that's a 605% increase. For Fannie to hit its target of $31.81 from $6.21, that's a 412% increase. So yeah, the risk-reward asymmetry there with that lower entry price for Freddie makes it a pretty compelling alternative.
Okay, so we have Ackman's thesis, his timeline, this Fannie versus Freddie dynamic, but now recent reports suggest that whole timeline might be getting blown up. accelerating dramatically.
That's right. The narrative has definitely shifted. Recent signals, apparently from the Trump administration, suggest they're now looking at an IPO for both companies much sooner.
How much sooner?
Potentially late 2025, maybe even November or December. President Trump himself has reportedly hinted at moving forward this year. It seems to reflect a bigger goal of cutting government liabilities and raising cash for the Treasury quickly.
Late 2025. Wow, that's, well, some experts are calling it extraordinarily aggressive. What does that do to the potential valuations we were just talking about?
Well, adding fuel to that fire is a recent interview with Treasury Secretary Scott Bessent. He floated the idea that during the IPO, the government might only sell a small initial stake, maybe 3% to 6% of Fannie and Freddie combined.
Just 3 to 6%.
Yeah, aiming to raise around $30 billion from that initial sale.
Okay, let's do the quick math for our listener here. If $30 billion is just 3%, that implies a total combined value of what, $1 trillion?
Roughly, yeah.
And if $30 billion is 6%.
Then you're looking at around $500 billion.
So suddenly we're talking about a pre-IPO enterprise valuation somewhere in the range $500 billion to a full $1 trillion. That's monumental.
It absolutely is. But it's really critical to remember that's the enterprise value before any debt or preferred stock claims. For common shareholders, any serious investment thesis still hinges on that crucial step, writing down the preferred stock purchase agreement, the PSPA.
Right. The big government claim needs to be dealt with first.
Exactly. But assuming that happens, then yes, these huge enterprise values translate into potentially much higher IPO prices for the common stock, maybe in the range of $50 to $100 per share.
$50 to $100 per share. That's a massive jump from Ackman's base case of around $35. You can see why the narrative is shifting so fast.
Absolutely. And plus, you know how these things go. High-profile privatizations often see a big pop on the first day of trading, so the actual value could spike even higher than the IPO price.
Okay, so for you, the listener, maybe you're holding preferred shares right now. How does this dramatically accelerated timeline and these potentially huge valuations change the game? What's the strategic thinking now?
Yeah, let's try to break that down with some simple numbers. It really shifts the risk-reward calculation. Imagine you have, say, $100,000 invested. If it's all in preferred shares, your maximum upside is pretty much capped, right? Maybe they go back to par value, you double your money, make another $100, total $200. That's your best case.
Okay, capped upside with the preferreds.
Right. But now, what if you think about rebalancing? Maybe move half of that $100 into common shares. So you've got $50K in preferred, $50K is in common.
So you give up some of that safer preferred upside for a shot at the much bigger potential gain in the common shares.
Precisely. Look how the potential outcomes change. With that blended portfolio, your preferred upside is now halved down to maybe $50,000 gain. But the common shares at 50K open up a much wider range. Let's imagine a worst case for the common, maybe heavy dilution. They lose 75% of their value. That's a $37,500 loss on your common stake. But you still have the $50,000 gain from your preferreds. Your net position is still up $12,500. You've got a buffer.
Okay, so even a bad outcome on the common doesn't wipe you out if you're balanced.
Right. Now, look at the base case Ackman's $35 per share target. That $50 King in common could potentially gain, say, $125,000. Add your $50 preferred gain, your total position gain is now $175,000. Better than just holding preferred.
Significantly better.
And now the best case scenario. If Beston's framework hinting at, say, $75 per common share plays out, that $50 in common could gain a massive $325,000. Add your $50 preferred gain, and your total position gain balloons to $375,000.
Wow, okay, the difference is stark. Holding only preferreds caps you around $100 K gain. Blending in common shares, the potential upside explodes to maybe $375K in that best case, while still offering a modest gain, even if the common part goes badly wrong.
It's a really interesting asymmetry. You're trading some certainty for potentially huge growth, but maybe without taking on catastrophic risk if you balance it right.
That risk-reward calculation is definitely striking. It offers a clear strategic angle for investors thinking about this. But beyond just individual portfolios, there's an even deeper layer here in Ackman's thinking. It's about how this plays out for the government itself. Let's really dig into his more nuanced argument about why the Treasury might actually choose to just deem its senior preferreds, that huge $350 billion claim, as fully repaid instead of trying to convert them into common stock.
Right. Just to quickly recap the basics, Treasury put in about $193 billion during the crisis. They got back senior preferred stock, the SPS, with a 10% dividend, and those warrants for 79.9% of the common. And as we said, they've already recouped $301 billion. That's an impressive return, like 11.6% IRR.
Good return for the taxpayer.
Definitely. But that SPS liquidation preference, Treasury's claim on the assets if things go wrong, it still hangs over the company's capital structure like a shadow.
And Ackman's point is that if Treasury actually exercises that preference, converts those preferreds into common stock, it would be totally counterproductive. It would basically wipe out the existing shareholders.
Precisely. He literally calls it a dilution death spiral. Think about the math. Say F2 have an enterprise value of $400 billion. If Treasury converts its $350 billion preferred claim into common stock.
There's only $50 billion left for all other shareholders.
Exactly. And then Treasury also exercises its warrants on that remaining value. The end result, Treasury ends up owning something like 97.5% of the company.
Wow. Legacy shareholders, the ones who held on through all these years, they'd be left with almost nothing.
Practically pennies on the dollar.
And what does that do to the broader market, beyond just those specific shareholders?
Well, it creates what Ackman calls a huge systemic risk premium. Investors everywhere would see a clear precedent. If you invest alongside the government in a rescued entity, the government might effectively just expropriate your stake if things get tough again down the line.
So future private capital would be scared off.
Absolutely. That risk premium gets permanently baked into F2's cost of capital. It makes it more expensive for them to operate, reduces their profitability, makes them more vulnerable. It becomes this negative feedback loop, undermining the whole goal of creating viable, privately owned companies that can attract capital on their own.
So it's not just about fairness, it's about long-term market efficiency and the actual cost of capital for these really crucial players in the housing market. But couldn't someone argue, look, the government took the risk, it deserves the maximum return, even if it means wiping out others? Stability first.
That's a perspective, sure. Stability is key. But Ackman argues that true long-term stability actually comes from having healthy, privately disciplined companies. Wiping out private shareholders achieves the opposite. It creates less stable zombie companies, as he calls them. And he also points out this fascinating thing he calls the mathematics of diminishing returns for the Treasury itself, especially as F2's valuation goes up.
Diminishing returns, how's that work? Treasury owns most of it anyway, right?
Well, yes, but think about the incremental benefit Treasury gets from converting the preferreds versus just relying on its warrants.
Okay.
Because Treasury already has warrants on 80% of the common stock, its extra gain from also converting the preferreds gets smaller and smaller as the total company value increases. So at that $400 billion valuation we talked about, converting the SPS might give Treasury, say, 17.5% more ownership than just using the warrants alone.
Okay, 17.5% extra. Seems significant.
But now, what if F2's valuation skyrockets to $1 trillion, like Besant hinted might be possible?
Wow.
At that point, converting the preferreds only gives Treasury about 7% more ownership than it would get just from exercising its warrants. The incremental benefit shrinks dramatically.
Wow, that is a huge difference. So at those higher valuations, Treasury captures almost all the upside through the warrants they already have. The extra complexity, the market damage, the political fallout from converting their preferreds, it yields very little extra return for them.
Exactly. It really highlights what Ackman sees as the elegant solution, especially from a political perspective. The administration wants to return these companies to private hands. Deeming the preferreds paid achieves that cleanly. It preserves meaningful private ownership. It allows Treasury to declare victory, point to its fantastic IRR.
Yeah.
And crucially, it avoids the perception of, effectively nationalizing critical financial infrastructure.
It also sort of validates the patience of those long-term shareholders, doesn't it?
Yeah.
And maybe encourages private capital to step in during future crises, knowing they won't just be wiped out later.
Right. It sets a positive precedent. So the path forward Ackman advocates is Treasury accepts its 80% ownership via the warrants, deems the SPS paid, captures the vast majority of the value appreciation that way, preserves market discipline, avoids the negative precedent, and gets privatization done faster. The choice, as he frames it, isn't just about ownership percentages. It's about creating viable, privately disciplined companies versus leaving them as these zombie companies permanently clouded by the risk of government intervention.
Okay, this all sounds incredibly compelling, a very strong case. But like any big opportunity, especially one tangled up with government policy, there have to be risks. What should people absolutely keep in mind here?
Absolutely, there are definitely risks. Number one is probably still political uncertainty. Despite the positive signals, a change in administration or even just a shift in policy priorities could derail this whole thing or significantly change the terms.
Politics is always the wild card.
Always. Then there are potential regulatory hurdles. Getting those capital requirement changes approved, for instance, that might face opposition or just get bogged down in bureaucracy. It might take longer than people expect. And investors also need to be aware of plain old market volatility. These stocks, especially the common shares, can swing wildly. And liquidity might be low at times, meaning it could be hard to buy or sell large amounts quickly without moving the price significantly.
So getting in or out could be tricky.
Could be. And of course, even with all the talk of acceleration, there's always the risk of delays in the timeline. Things just take longer than planned. That ties up capital, increases uncertainty. And finally, basic operational risks. What if interest rates spike unexpectedly? What if there's a major downturn in the housing market? Those things could still hit F2's earnings and impact their valuation, regardless of the privatization outcome.
Okay, so bringing all these threads together now, we've gone deep into Ackman's thesis, the common versus preferred debate, the accelerated timeline, the valuation shifts, the nuance around the SPS. What's the ultimate takeaway here?
I think it highlights a really fascinating asymmetric investment opportunity. That's the term Ackman uses. It rests on a few key pillars. The idea the government's already been paid back, the fact that Treasury has huge upside anyway through the warrants, and the strong political and economic incentives for the government to actually respect shareholder rights this time around. You combine that with the potential returns being projected, plus this possibility of a much faster timeline and even higher valuations. It paints a really compelling picture, albeit one with, as we just discussed, significant risks attached.
Yeah, it really reveals how all these layers, complex financial strategy, political winds, market sentiment, could all converge to completely reshape these two giants of the U.S. housing market. It's also a reminder, isn't it, that sometimes the best deal, maybe even for the government in the long run, isn't about squeezing out every last percentage point of ownership. Maybe it's about creating the most durable, healthy, long-term value for the companies, for the market, and ultimately, maybe even for the taxpayers, too.
Absolutely. And maybe here's a final thought for you, the listener, to chew on. If this path Ackman outlines, where Treasury strategically forgoes converting its senior people, preferreds to allow private capital to thrive and ensure the long-term health and market discipline of F2, if that proves successful, what other past government interventions, maybe in other sectors, might have actually benefited from a similar, perhaps less extractive, more long-term, value-focused approach?
Something to definitely think about. Thank you for joining us for this deep dive. We hope it's given you a valuable shortcut to understanding this really complex but incredibly important story. Until next time, keep digging deeper.